Are you ready?
I am ready.
Okay, so good morning, everybody. Welcome to our first ever Maze Live virtual. Because of the circumstances, we usually do this in person, but we are happy to have you here. This class is hosted by Maze and Associates. I am Catherine Yuan, one of the partners at Maze and Associates. I will be your moderator today. Many of you already know our firm, but if you don't, we are a full-service CPA firm offering services in accounting, auditing, information technology, and tax. I am going to go over a few of the housekeeping items before I turn over the screen to our speaker today for the presentation. First of all, if you are encountering difficulties in using Zoom, please use the chat function to get help. You should have received an email this morning for of the PowerPoint used in this presentation. If you have not yet received a copy, please use the chat function and let us know, and we will send you a copy. During the presentation, if you have any questions for the speaker, you can use the Q&A function on your screen. The speaker will answer some of the questions during the presentation and defer the rest to the Q&A session at the end of the presentation. Please keep in mind that this session is recorded, so if you prefer, you can ask your questions anonymously. There are 4 polling questions during this presentation. In order to get the CPE credit for this class, please answer the polling questions. Whether or not you get the right answers do not affect your CPE credit. That's very important because I often get it wrong. So we don't judge. Just click an answer and so that we know you are there basically. If for any reasons you cannot answer the polling questions, please send your answers through the chat function so that you can still get the credit. When you exit the Zoom presentation at the end, it will redirect you to a survey. Please fill it out so that we remember to send you the CPE certificate. Now, Mary Beth, are you ready for your my introduction to you? That is so
I'm ready.
glorious. Okay, so now I'm going to introduce Mary Beth. With over 30 years in employee benefits experience, Mary Beth has served as retirement consultant for a wide range of public agencies, specializing in pension and retiree medical benefits. Mary Beth focuses on understanding benefit programs and clearly communicating long and short-term considerations so clients can make the best decision possible for their organization. Most recently, Mary Beth has been involved with helping California public agencies, including CalPERs cost-sharing plans. Hold on. I need to take a breath. It's implementing gas fee statements 68 and 75. She speaks on current topics including CalPERS contribution rates and supplemental pension trusts, as well as the new gas fee accounting rules to retirement boards, city councils, board of directors, and employee and professional groups. Mary Beth also writes for Bartell Associates website. I don't know how you have time to have a personal life. That's a lot going on. So with that, Mary Beth, welcome and thank you for teaching us today. And it's off to you.
Well, thank you very much, Catherine, for the lovely introduction. It sounds much more intense, I think, than in real life. I'm really happy to be here speaking today. I guess I wish I was there with all of you in person, but right now you're hearing me talking from Pasadena, and we'll just pretend everyone's in the same place. I cannot see all of you who are listening, and I can't see whether you're, if you have questions on your faces, I can't see that. So as Catherine said, please feel free to use the Q&A function. If I've skipped over something or something isn't clear, I want to address it at the time. And then I'm happy to talk about big picture questions and topics at the end. I think we'll have plenty of time left. Okay, so we're going to jump into it and talk about CalPERS, mostly about CalPERS this morning. Can I make my screen turn? Let's see. There we go. We're going to talk a lot about what happened with CalPERS investment return, a little bit about PEPRA normal cost, a little bit about OPEB, and then a little bit more at the end about pension trends and what's going on with pre-funding. Okay, so first, CalPERS investment return. I think this has been the biggest question in everybody's mind for about the past 3 months, or I don't know, maybe you have minor worries like coronavirus, but some of us worry a lot about CalPERS. So we've been thinking about this. And let's just step back a little bit and start with saying, where does your CalPERS unfunded liability come from and what can influence? Okay, so the unfunded liability, remember, is the difference between two numbers. It's the difference between the actuarial liabilities. That's the value of all the benefits you're going to pay out in the future from your CalPERS pension plan. And they go by two names. If you're talking about funding, it's called the actuarial accrued liability, but if you're in the accounting world and talking about your GASB 68 numbers, it's the total pension liability. And there's small differences between them. The numbers are never the same, but really they're the same entity, the same concept. So we're talking about the unfunded liability, the difference between the actuarial liabilities and the plan assets. The assets are called assets, except if you're doing accounting again, in which case we call them fiduciary net position, but they're the same thing. Okay, so what makes them change? The actuarial liabilities, there's a lot of things that can influence these because you're talking about the value of things that are going to be paid a long time in the future. And in the past several years, a lot of the increases in liabilities have been due to things like changing mortality, how long people are going to live. And we know people are living longer and longer. But if you think about it, those changes, we saw a couple 3% of the liability. So even though they're big, they're very big, they don't come up every year and they're sort of limited. They can't be too big. We get changes if CPI is ever over 2% and we have higher cost of living increases than expected. We might get changes in the liabilities. We get changes in the liabilities from pay increases being not what were expected, from people retiring at different times than we thought. CalPERS changing the discount rate, although hopefully we're kind of done with that for a while. So there's a lot of things that can influence the liabilities, but typically they're not really that big. On the plan asset side, there are gains and losses or changes every year due to investment return not being what it was projected to be. And if you think about it, that can be a really big number. Okay, CalPERS projects 7%, but it's very rare that they're probably even within 1% of 7%. Typically, they're a lot farther away, and what they're hoping is the pluses and minuses equal out over time. Okay. So what was investment return like for this year? This is a picture of the S&P 500 for the 1920 fiscal year. And it was quite an up and down year. We started over here. I'm hoping you guys can see the cursor. Over here in last year in July, the market was kind of, bouncing around. And then in the fall, it started a very steady climb up towards the end of the year. It kept climbing, climbing, climbing. And then we hit the coronavirus news in February and the market dropped significantly.
Mary Beth, I can see your cursor.
Oh, so great. Thank you.
Okay, you're welcome.
So we come down here at the end of the March. I'll have to share one thing with you guys all. I knew it was the bottom of the market because my husband said to me, I think that exact day, I'm getting worried about the market. Maybe we should start selling some of our stocks. And he's very good at picking the absolute wrong time to do it. So that's how I knew it was the bottom. But it did turn out to be the bottom of the market. And at that point is where we were looking at CalPERS returns and saying, they're going to be like minus 10% for the year. And maybe if this keeps going, we might be looking at minus 20% or maybe 2008 and 9 again. But that didn't happen. Starting in April, the market climbed up again, up and up and up. And here we are at the end of June, and really not that bad compared to the beginning of the year. So that was what the stock market did. Now the question is, what happened to CalPERS assets in that time? This whole presentation is a bit of guessing about the returns. They're going to release them officially at the board meeting on Wednesday. So if anyone wants to know for sure what the returns were, tune into the CalPERS board meeting Wednesday and you'll be among the first to know. But we guess at it, and here's how we guess. CalPERS posts the total value of their assets on the website. They told us that at last June, it was 373 billion. This June 30th, it was 389 billion. So if I do my math, I can calculate that that's a 4.29% increase in the assets. Not bad. But that's not the final number for several reasons. First of all, it ignores cash flow. So what we're really interested in, what was the return on the assets? And we know the asset values went up. If I can do that, $12 billion. What if they had gone up $12 billion because somebody deposited $12 billion into the fund? Obviously, then the return was zero. So we need to know what the cash flow was to do that calculation properly. Secondly, we don't know what the expenses are and whether or not they're actually pulled out of these numbers. When CalPERS credits return to your assets and your fund, they've already pulled out the administrative expenses of running the plan. And so they might do something like last year announcing a 6.7% return, but the amount that actually was credited to accounts was more like 6.55 because the expenses come out of it first. So we don't know to what extent this would be further reduced for expenses. And then finally, the last thing that's not there is what I'm calling the asset class reporting. Okay, look at the next slide. CalPERS has their assets allocated to many places. The biggest pool is public equity here, you know, sort of stocks and bonds and things, and then income, sort of fixed income, a little bit in liquidity. But there's two pieces here that are actually a fairly big part of their fund, altogether 18%. One is private equity and one is real estate. And those things are not valued on a daily basis. You can't go on the internet and say, what was the value of them today? They take some analysis and some valuation services. So those are not in the number that gets posted on CalPERS website. We're not quite sure of the numbers that CalPERS posts when those things were last valued. So that is a fairly big question for the total return for the year. But I guess we'll know on Wednesday. Okay, so what is the impact of the CalPERS return for the year? And let's assume it's sort of in the 4.25% ballpark. How would you determine how big of an impact this has on you? Well, the first thing to do is say how much was the loss. So what's the difference between the 7% return that CalPERS expects and the actual return they got? We'll take that and we'll apply it to the plan assets. Then we'll take, so that amount is a loss for the year, the shortfall, the amount less than 7%. We're going to take that amount and amortize it or pay it back to CalPERS over 20 years. And it's not paid off levelly. You can calculate the level dollar amount, but then there's a 5-year ramp up. And what that means is the first year you make 1/5 of a full payment. The second year you make 2/5 of a full payment, and so forth until in the 5th year you get up to the full payment for the rest of the time period. And then that payment schedule doesn't actually begin until fiscal year 22-23, which seems at this point like a long way out. How do you remember it's 22-23 or why is it 22-23? Well, the return we're talking about was for the fiscal year ending June 30th of 2020. So the first time that's going to go into CalPERS's calculations is for the valuation date of June 30th, 2020. That's the report that's not coming out this August. It's coming out a year from this August, July or August. So that report will come out in the year 2021. And because it's already into the 2021 fiscal year, it will give the contributions for 22-23. So that's why it's so far from now, just a lag in timing. Okay. So what might the dollars be? Let's look at a plan that has $10 million of assets. So the first thing we'll do is take the difference between the 7% expected return and the actual return, and I'm going to say it's 4.25. So the shortfall is 2.75%. So the next thing I do is I multiply 2.75% times the $10 million of assets, and my loss, the shortfall to the fund over what I was expecting, is $275,000. Doesn't seem like quite that much, does it? Okay. So then we move on and say, how are we going to pay back this $275,000? Well, it's going to be amortized over 20 years. It's a level dollar amount, 7% interest with a 5-year ramp up beginning in 22-23. How are you going to figure that out? Well, you could ask your calculator if you have a financial calculator. And if you put those numbers into your calculator, the 275, the 7% interest, a 20-year payment, it might tell you that the payment is about $26,000 a year. But that's not the right answer. Okay, because CalPERS is much more complicated than that, and it's really hard to get your calculator to give you the right answer. So I'll just show you what it is. For a $275,000 asset loss, here's the schedule. We know the first year is payment in 22-23. It's 1/5 of the total payment. So the first year, you're only going to pay $7,000. The second year, $14,000. The third year, $21,000, then $28,000. And finally, in the last 15 years, you're going to pay $34,000 a year. So not a lot of money for a plan that had $10 million of assets. The other thing to note is that the final payment, when you get up to the full payment, is $34,000. If we had calculated it, we would have gotten almost $10,000 less, $26,000. Why is this number so much bigger? It's bigger because you've been deferring the payments out. It takes so long before you make the full payment that that shortfall has been growing and growing with interest in the meantime. Okay, hopefully everyone's with me. Oh, forgot to tell you the little hints. If you want to know how to calculate that number, if you want an estimate, it's about the first year's payment is about 2.5% of the asset loss. Okay, and the last payment is 5 times the first payment. Okay. So suppose you wanted to calculate this for your own agency. How could you do it? Well, the first thing you have to do is figure out how much assets you have in CalPERS. And that means going back to your 2018 valuation reports, so the ones you got last summer, and add up all the assets in every plan. If you're a large agency, you might only have 1 or 2 reports. But if you're in the risk pools, this could be, I want to say 6 or 9 reports or more. You could have lots and lots of little ones to add up. Typically, only a few of them have big amounts of assets, so you could always just do them to estimate. But add up all the assets from 2018, multiply it by 6.5%. That's about what we think funds earned in 18-19. And then that will get you up to June 30th, 19 assets, and then you can go and do the calculation we did in the last couple slides. There's other ways to find it out. CalPERS has a little dashboard, a dashboard tool that will tell you what the impact on your contributions is from different investment returns. So you could use that tool, but right now it's not available for plans that are in the risk pools. Hopefully they think this fall. Or you can drop me an email and I'll send you a little spreadsheet. We put together a simple little modeling tool that estimates that if you put in the return you think you'll get or CalPERS will get. So if you want a copy of that for your agency, just let me know. Okay, so here's my takeaways about CalPERS return for the year. 4% or 4.25% is really not nearly as bad as we thought it could be. There were a few weeks where we were thinking negative 10% or more. So this is really not so bad. The full impact of this is really delayed a long time. It's not till 22-23 that you start paying it, and 26-27 before the payments ramp up to the full amount. So it's nothing that's going to hit you next year, and hopefully by the time we start paying more, things are looking better. The last takeaway is probably the biggest thing. We don't know what's going to happen next year. I'm not an investment person. I don't understand why the stock market seems to be so happy with things, with everything that's going on in the country. But if it does turn around, we could have a bad year next year. And so we always want to keep that in mind. The analysis would be very much the same, though. Even if next year is a very bad year, the payments won't be immediate. They'll be delayed for several years. Okay. So we're going to start with the polling questions.
Okay, I'm going to launch the polling question again. If you want CPE credits, please answer this question. There we go.
Okay, so here's the questions. Let's say CalPERS investment return for the year was 5%. What would be the investment loss? And the first choice is no loss at all. Everything's good. They got 5%. Is the loss 5% of the unfunded liability, 2% of the unfunded liability, 5% of the plan assets, or 2% of the plan assets? Okay, so you have 5 choices. And we'll let it go a little bit longer. I can't tell, Catherine, can you when everybody's answered?
I think about like 100 people have answered it, maybe.
I think people
Oh,
are done.
111. Okay. 112. Do you think?
Okay, last chance to get your answer
Last
in.
chance. So let me know, Mary Beth, when you want me to
Okay,
stop.
I think we're done.
Okay. Okay. So this is the result.
So most of the people got the answer right, but not everybody. So let's see. Do you want to stop sharing the results for a second?
Sure.
Can turn the last slide. Oh, sorry. Okay. So the answer was 2% of the plan assets. Okay, so I like people who chose everything's good if CalPERS earned 5%, but it's not. Remember that the loss for the year is the difference between the 7% CalPERS expects and the 5% they got. So the loss is 2%, and it applies to plan assets. And that's important because plan assets are always much, much bigger than your unfunded liability. Okay, so we're going to go to question number 2. I apologize for putting them back to back, but these are kind of key concepts. Can you show us number 2, Catherine?
Yes, hold on one second. Number 2. There we go.
Okay, so this one looks scary. I'm going to read it and let everybody think about it before you answer. Okay, so let's suppose your investment loss was $500,000. So $500,000 shortfall. How much is your contribution going to change? Is it going to change $25,000 a year every year beginning next year? $100,000 a year beginning in 22-23? $13,000 a year increasing to $65,000 beginning in 2023, ramping up to 26-27? Are you going to pay $37,000 a year, increasing 3% a year for 30 years? Or are you going to make a $500,000 payment next year and be done with it? Which of those are the required contributions?
Okay, and there's a question, Mary Beth.
Yes.
Should I ask you now or should we wait?
Why don't you ask it now?
Okay, can we pay off the loss up front?
Yes, CalPERS is always happy to take your money. So I think what you would do is you would send them the money. They would probably be happier if you waited until next year when that valuation comes out and say, this is to pay off the investment loss. They would be thrilled to get that. And it would be very good for you if you could pay it off all at once.
Okay, do you want about 113 people answer? Is it good to stop it?
Yeah, actually we're getting a couple more people just decided to answer. We're up to 116. I think we should close it.
Okay. And then there we go.
Okay. And everybody did great. Not everybody.
Yes.
Almost everybody did great. Did you get the right answer, Catherine?
I just copied what most people say, so.
Okay, so I tried not to rely too much on the math here, But the answer was the middle one, because that's the only one where we had a ramp up in the contribution for 5 years and got to 20 years total. But again, remember, the numbers are really not that big. It sort of seems like compared to $500,000, it's paid off very slowly, it's delayed for a long time, and the numbers aren't huge. If you did want to do this, pay off, I think that's what our questioner asked, if you did want to pay the $500,000 now or soon and get it paid off, that would be great if you could do that. Okay, I'm going to go and switch topics a little bit and talk about PEPR normal cost. I think we talked about this in the past and other years, but I just want to make sure, sort of give everyone a refresher and make sure you're thinking about this, because it is the beginning of July, so probably we've just done first payroll in July. So PEPR member contributions, the PEPR employees are meant to pay half of the total normal cost rate. And that number is going to change or could change every year as the calculation of normal cost changes. And CalPERs does that calculation one of two ways. Either they look at your actual plan and your actual people and calculate what half of the normal cost is for your group, or if you're not in a risk pool and your group is not big, then my microphone's working. Okay, if your group is not that big, they will do it on a pooled basis until you have enough people. So there can be a little bit back and forth about how that's calculated. But the good thing that's happening now is that for most agencies, CalPERS is putting that required contribution right on the front cover of your valuation report. Index D. So let's see what that looks like. Here's the front cover of a 2018 report. You get this nice little exhibit about required contributions. So it says for fiscal year 2021, that's the year we just started, the employer normal cost rate is 21.6% of pay. And it'll show us the employee rate, 12.75%. So the first thing you wanted to do last August when you got this report was to check that employee PEPR rate and see if it changed from the prior year. And when you get your new reports this July or August, you'll want to, again, look at that PEPR rate and see if it's changing. If it is changing, you need to keep it in mind, particularly if you're bargaining with employees. You want to know if that's going to be impacting them. Not all reports actually say employee PEPR rate there. A few of them say see Appendix D. If it says Appendix D, you'll go back to page D2 of the report. And again, this is not the risk pools. And what you'll see there, if you look at this plan actually has two separate PEPR tiers. They have a peace officer and sheriffs, but you could have changed your PEPR formula. There's a lot of reasons you could have more than one tier. And if the contribution rates are different, you'll only find it back in Appendix D, and you'll see the two rates there. It'll also be telling you if there was a change needed in the employee rate. So again, this is something you really want to know as soon as possible. If you want to know a little more information about what's going on with your PEPR rates, you would look at the page before it in the report, page D1. And this is just a piece of it. This lists every single CalPERS tier you have, potentially more than you think you have, because sometimes little tweaks were made to the formulas. And so you might think you only have tier 1 and PEPR, and there might be 3 or 4 different levels listed here. But for each different level you have, it will show you what the total normal cost rate is, even for your classic people. So sometimes that's kind of nice to know. And then how many people you have in their payroll. So for this plan, I can look at the 3 PEPR levels I have, what their total normal cost is, and I know that eventually employees in that tier are going to be paying half the normal cost. Okay. That was our whole heads up on employee normal cost for PEPR, folks. Okay, and if there are no questions, I'm going to go and talk about OPEB for a while. Okay.
There's no question.
Okay, good.
Okay.
So we'll talk about the OPEB discount rate. And I think this is maybe a bigger deal than CalPERS investment return. It depends a lot on your plan and what's going on with it. But let's take a step back and talk about the discount rate for OPEB, for retiree medical. If you are pre-funding in a trust, and if you're trying to parallel to pension, everybody in pension and CalPERS is pre-funding in a trust. So OPEB is where we see people without a trust. If you don't have a trust, the discount rate that's used to calculate the present value of all these future benefits, it's the rate of return on the trust assets, or what we expect the rate of return to be on the trust assets. If you're not pre-funding, you need to use a municipal bond rate. And there's, kind of your choice of municipal bond indexes. They have to be average about 20 years and certain quality. And there's a couple of municipal bond rates you could pick from. But you don't get that much of a choice. You pick a bond index and you stick with it. The municipal bond index, the bond rates, are very volatile. We've been saying that for a while, and I want to show you a picture of how volatile they are. This is the chart we've been keeping on our website back since June of 2013, and it tracks quarterly the different bond indexes that people could use to do their GASB 68 and 75 reporting. And you can see that there's been a lot of ups and downs to them. I want to focus a little bit closer on the rates we use for OPEB plans because they don't go back quite as many years. It's a little bit easier to see. This green line is a bond buyer 20 rate. That's our most popular one. I think because it is the rate that the Federal Reserve used to publish back when they used to publish rates. And if you look at, let's say, June 30th of 2019 here, that's the rate that most people, because of the lagging of a year, that's the rate most people are using as a discount rate for the June 30th 20 reporting, 3.5%. If you were using that rate, last year you used 3.87, the year before 3.58, not especially volatile. Next year, you're going to use 2.21%. Big difference. The other rates aren't quite as up and down if you are using this light blue Fidelity rate. If you are using S&P, this rate is actually pretty funny, I think. If you look at on the June 30th, we had 3.13, we had 2.98, 2.79, 2.66. Doesn't actually seem to move a lot on the June 30th, but in between it's gone all over the place. So particularly for people using the bond buyer, you're going to see a big, big drop in the rate for next year's reporting. Okay. So what does this mean to your OPEB liabilities that you're reporting for GASB 75? Well, if you're pre-funding in a trust, the discount rate is going to be the expected rate of return on plan assets, and that's not going to change. You are going to have an asset loss, kind of the same way we talked about for CalPERS. It might be as much as 5% of your assets, probably not that big of a deal. Particularly because a lot of plans that are funding don't have that many assets right now because they've just started funding. If you don't have very much assets, there's not a lot to lose, but you still keep your same discount rate. If you are not pre-funding and you're using the bond buyer rate in particular, you'll see that drop 130 basis points. That could increase the total OPEB liability 15 to 20% or more. So quite a big change in the OPEB liability you're going to report next year. Okay, polling question number 3.
All right, polling question number 3. I'm just going to copy other people's answer. I'm going to wait to see like, which one's the most popular.
Okay, so
what? Okay,
if you have an OPEB plan, how will your GASB 75 net OPEB liability at the 2020 measurement date compare to 2019? Is it going to be a lot lower? Is it going to be kind of the same? Is it going to be higher, or does it depend on if the plan is pre-funded in a trust? Okay, people are taking longer to think about this. Either that or they were off getting a cup of coffee. Give a couple more seconds. Okay. Oh, I was just about to say we've got everyone who's going to answer, but we got a few more trickling in. Okay, I think we're good.
Okay.
So everyone saw the results. The winner was, it depends. And it turns out that is exactly the right answer. So there's really two different answers depending on what's going on. If you were pre-funding, we think it's probably not going to be that different. But if you're not pre-funding, the liabilities are going to be much, much higher than you're reporting this year. Okay. Not that we think that the liabilities you report in your financial statements have a lot of bearing on reality, but it's still good to know ahead of time that this is going to happen. Okay, I'm going to take a couple minutes before the last section and just talk about CalPERS plans funded status and show you some pictures because we've been doing a lot of numbers. And I guess say, bear in mind, these are June 30th, 18 valuation reports. The pictures won't look quite as good for the reports that are coming out this summer. Okay, so this is a picture of trying to convey to you what the funded status of CalPERS pension plans look like. This particular chart is including only the miscellaneous plans, and it's cities, towns, and counties only. There's 485 public agency, city, town, and county plans in CalPERS that are sort of active and ongoing. And so here's how we do this. If we could make a really, really fine picture, you would see 485 columns in this chart. And we can't show the lines that fine, so I'm going to try to say to you how I envision this chart. I envision every single city, town, and county who has a CalPERS miscellaneous plan sending a representative out to a meeting, and all of them get a little sign that says, what's the funded status of my plan? And everybody holds up their little sign that says, I'm 72%, I'm 71%, and we line all 485 of them up in a row according to their funded status. Okay, so imagine that this chart is 485 people all lined up with little signs about their funded status. And we count down and we find the exact middle of the line. That's right here. And the person who's standing at the exact middle of that line has a little sign that says, my plan is 72% funded. So that's what we mean when we say the 50th percentile plan, the plan right in the middle, is 72% funded. So we don't maybe, the middle is interesting, but I'm also a little more curious about what's happening to the sides of that. So if we walk down the line and we get to the person who's a quarter of the way from the beginning, they're 69% funded. If we walk the other way and we get to 3/4 of the way, 75th percentile, they're 76% funded. This is really flat. There's not a lot of difference. A 1% change in your funded percentage is going to push you way up the percentiles. Okay, everything is very close together. All these plans in the middle are very close to equally funded. When you start getting to the tails below the 10th percentile and above the 90th percentile, you see a lot more steepness and a lot more, plans are just different. But in the middle, everyone's kind of the same, which, kind of surprises me a little bit. Okay, remember 72? Similar picture for miscellaneous special districts. There's a lot of them. And remember that a lot of these special districts are very, very small. And their median is 76% funded. And they have a lot of outliers here who are very well funded. We look at safety plans. Okay, cities, towns, and counties only. There's only 373% of them. Their median is a little bit lower than miscellaneous. They're a little bit lower at 25th and 75th percentiles, but again, really pretty flat and stable and steady in the middle. And then again, you have some safety organizations that are very well funded, and on the low end, we have some that are actually worse funded than the lowest miscellaneous plans, but very, very stable in the middle. And then the last group we have are special districts, safety special districts, better funded than cities, towns, and counties. There's only 146 of them. So these are typically like your fire districts, fire prevention districts. A little better funded than cities, towns, and counties. We have a lot more people up here on the upper end, but again, just not a lot of difference percentile-wise between 25th and 75th percentile. So I like these charts because a lot of governing bodies really ask us, what percentile are we? How do we compare to our neighbors? How do we compare to everyone else? Are we better than everyone else? Are we worse than everyone else? And this kind of shows us that, you know, even if I told you you were 25th percentile, you're just not that different from the people at the median or the 75th percentile. Everything is very much bunched together. You don't want to be down here. You might not mind being up here, but if you're in the middle, it's all very, very close. Okay, I have a polling question number 4 for you. Let's ask really quickly. I kind of like those charts, but I'm curious about what everybody else here thinks. Do you like them? Do you think this would be helpful, or do you not really have an opinion?
I personally really like them because I get asked that question a lot too in council meetings. So it helps to, you know, have this visual.
Okay.
They are
great.
loving
People
it.
like them. Either that or they just want me to finish the session and not walk out because no one liked my charts. Okay, I want to make sure we get time for everyone to answer because everyone wants their CPE credit.
Okay, and Mary Beth, there's a question. Do you want to take it now or?
Sure.
Okay, so the question is this funded status the actuarial funded?
Yes, this is from the funding report, so it's not from the GASB 65. So it would be the funded status that shows up in your funding report.
Okay, should we end the poll? What do you think?
I think we should end the poll. I think we got everyone who's going to answer.
Okay, so there's the result.
Okay, 87% yes, that's great.
We also have a question on the chat.
Okay.
Go.
So someone asked, will the funded status charts be updated this summer after all the CalPERS valuation reports come out?
I would like to, but I don't think it's going to be this summer. Last year we had asked CalPERS to give us a big data file, a dump of all their reports, and we got it in sort of October, November. So by the time we get that, I'd like to update those charts because I think they're kind of cool.
And Mary Beth, at the end of the slide, do you have your email address there? If not, we can. Somebody asked if we can share your email address.
It's definitely on the front cover.
Okay. So
yeah, I don't think it's at the end, but it'll be at the front. And if you have the slides, you should be able to see it.
Okay. So, and if anybody still cannot find it, please let us know, and then we can send it through the chat and give it to you at the end. Okay. You're so popular now. People want to talk to you personally.
It's because I'm offering them free goodies. Okay, I'm going to move on. I think we're good on time. We're going to talk a little bit about, if I can get this to turn, pension trends, just kind of what's going on in paying down CalPERS unfunded liability, and hopefully people are still able to do that. So whenever we talk about paying down your unfunded liability, there's really two parts to the question. One, how do you get money? You need money to pay down the liability. You can't just write a really nice letter to CalPERS and ask them to get rid of some of your unfunded. You have to give them some money. So how would you get it? And then if you had money and you're wanting to pay down your unfunded liability, how is the best way to go about that? Okay. So one of the things that's really been very interesting to me is we're seeing a lot of activity with pension obligation bonds. So if you think about what happens with a pension obligation bond, is that you, the agency, go out to the market people, investors, and say, I want $200 million to pay off my CalPERS unfunded liability. Will you lend it to me, and how much are you going to charge me? And what we've been hearing is that these days, the rates people are getting are sort of in the 3 or 4% neighborhood. So you borrow money from your bondholders at, let's say, 4%. You give that money to CalPERS. CalPERS hopefully earns in the long run 7% on that money. You're paying your bondholders 4%. Great, you've made a ton of money. Maybe, because that's all very long run and there's lots of ups and downs and there actually are risks involved to it. But the farther and farther the rates get away from lower than CalPERS 7%, the much more likely it is that these are a good deal. And so a lot of people are very interested in them. We've seen, I want to say the list I saw had maybe 10 deals that had closed so far in 2020 compared to, 1 or 2 most other years. And many of these were closing after March, so April, May, and June. So the COVID stuff has not slowed this down very much as far as we can tell. Why? I think that so councils and boards are often not interested in taking out bonds, are often not interested in borrowing, but I think some feel that with the rates being so low that the risk is to an acceptable level and they're interested in doing it. And we've seen some pretty conservative agencies go on and issue bonds or are in the process of issuing bonds. The other reason I think it's happening is that there's some agencies where they feel that taking out a POB, smoothing their payment pattern in the future is the best solution to the rising CalPERS rates that we see going forward, or maybe even the only solution, and they're willing to take on the risk because they need a good solution. So that's, I think, is just really interested. I'm not trying to advocate for pension obligation bonds, but want to let you know that this is something that's very different than we've seen before. So pension obligation bonds are a way to get a lot of money all at once. There's a lot of other strategies people are trying for getting, sort of small pieces of money. One that's been used very effectively is just having a policy for what you do with one-time money that you have at the end of the year. So you would ask your council to pass some sort of resolution that says, when we have money at the end of the year, we'll use half of it to pay down our pension obligation, something like that. Yes.
There's a question. What's the due date for pre-funding this year? It is usually in July.
I believe it's the end of July. I did not look up the date. Okay. So bullet point number 2, what we've seen some people doing is prepaying their contribution in July, but instead of taking the 3.5% discount, they pay the full amount. So they're paying 3.5% more than they need to. That's an additional contribution. And if you do that every single year, it actually adds up to quite a lot of money. Another sort of small money solution is to say that I've budgeted for my personnel costs, I've budgeted for, I have a certain number of budgeted positions, I've budgeted for paying CalPERS on those positions. I'm going to make that payment even if those positions are vacant. So that's sort of a way to say there's money in the budget, I'm going to take that, I'm not going to let it become extra money, I'm going to ship it off to CalPERS and say, CalPERS, here's an additional payment. So there's a lot of ways people are looking around their budgets and finding, what might seem to be little bits of money here and there, but if you do it very consistently over a long period of time, all that money adds up and can really make a noticeable change in your unfunded liability. Okay, so let's say you did one of these things and came up with extra money. How do you pay down the unfunded liability with that? Well, the general concept is this is an obligation you owe. You're being charged interest on it. So the more you can pay and the sooner you can pay, you're going to save money in the long run. Okay. The trick is, though, if you're trying to actually pay off the unfunded liability, you have to kind of work around CalPERS, because if you give them extra money, they're going to respond by reducing the contributions in future years. They're going to say, you've paid, your plan is better funded than we expected, so we don't need so much money, so lower your contributions. You have to not let that happen. So you have to keep paying extra money to CalPERS. So they will lower your contribution. You need to pay more so that you pay what you would have paid if you hadn't made the extra payment. And then they say, oh, that's another extra payment, and so they're going to lower the next year's even farther. So there's some math involved in doing those calculations, and also internally in telling people, no, that's not an extra payment I'm asking you for this year. I'm just asking you to pay what we would have paid if we hadn't made that one lump sum payment. So there's managing people and expectations too. An easier way to do it is to make your additional payments to a supplemental trust. Then CalPERS won't know about them and they can't reduce your future contributions. So it'll automatically work out okay. A chart that kind of compares supplemental trust to CalPERS, and notice the second bullet in it. We think the supplemental trust, even though it might be easier to manage something like not letting CalPERS reduce your future contributions, we think it likely that in the long run it's probably going to have a lower return, likely because they have higher investment expenses, higher administration expenses. And if you put money in a supplemental trust, it's not going to count against your GASB unfunded liability, although you can, it is still an asset of your agency and you can point it out and highlight it. The last thing I would say in favor of supplemental trusts is they're much more visible. So if you want to be able to track this money, you can do it in a supplemental trust. But really the difference, we get asked all the time, what should I do with my money? Should I put it in a supplemental trust or give it to CalPERS? The answer is really different for every single agency. So you want to think through it. Before you do anything, remember that especially with CalPERS, you're locked in. That was my last slide. I guess I didn't do a good job saving 15 minutes for questions, but we have a couple minutes left and I can stay on the line after 10 o'clock if people have more.
Yes, so yeah, if you have any questions, you can please stay and ask us question. There's a question about if this recording will be available to participants. We will put the recording up somewhere. I need to ask my IT person, but it will be available and we will send out the link. So any other questions?
Let me go back to the beginning then, if I can. Sorry to make you guys dizzy, but there, you can see on this slide is my email address.
So there's a question, is the league or state working on a PEPRA 2 to your knowledge?
I know that there's a lot of talk about it in the league. The league would like to do that, but I'm not sure how energetically they're working on that. With everything else that's going on, they may well have decided to focus other places. So there's nothing, definitely if you're trying to plan your city and your budget, I think that any changes that might happen from a PEPRA 2 are way farther out than you're budgeting.
Okay, so next question on POBs, are there a pledge of general fund revenues required?
I can't answer that question. I'm sorry, but I assume that you have to promise something to get people to lend you money at a good rate.
So any other question? If not, then, well, I would just want to thank everybody for coming today. And thank you, Mary Beth. It's been very educational. And so if you have any questions, feel free to, I'm just going to offer you, feel free to email Mary Beth or you can email us. And it's been a pleasure. We have 5 other classes that it will happen throughout this week. And if you can, please join us. And if you have any feedback for us, please do fill out the survey at the end. And so that will give you the CPE certificate. Mary Beth, thank you again.
Thank you, Catherine. I'm really looking forward to next year because I think this format is working okay, but I really like seeing everybody in person. So hopefully we'll be able to do that next year.
Yes, same here. I would love to see everybody in person so we can talk and, you know, reconnect and stuff. Okay, well, everybody stay safe and have a great day. Thank you.
Okay, thank you.
Thank you. Bye-bye.
Bye.